President Trump's re-election for his 47th term will likely be one of the most prominent economic events of 2024, especially with the possibility of gold prices dropping sharply. The question is, with President Trump's presence and power in the White House in 2025, will gold prices continue to decline if his promises to end wars and recover the economy come to fruition? We are witnessing a complex, multidimensional global monetary market with the emergence of non-traditional digital money, such as Bitcoin. We have also witnessed gold being completely detached from the value of any currency worldwide since the early 1970s. However, the paradox with gold prices is that they have quietly been rising, even as the Fed has started a cycle of interest rate cuts. The year 2024 closed with a noteworthy event. Gold set a new record. So, what is driving gold prices so high? And will these factors still be present in 2025? After studying the history of global gold prices, we have identified two main reasons. Firstly, it's not due to war. The issue with gold prices stems from public debt. We all share a common perception that whenever there is war or armed conflict, gold prices rise as capital seeks haven. This is a completely accurate understanding, as historical data on wars and gold prices has proven this point. However, this perception cannot explain the surge in gold prices following the 2008 global financial crisis and the COVID-19 pandemic. During those times, we did not have large-scale, prolonged armed conflicts like we are seeing today. We have observed that gold prices tend to spike whenever public debt in the US and other major economies surges. The US is also the country whose dollar dominates the global financial system. Public debt always rises sharply due to two primary factors: war and economic crises. War fuels public debt, leading governments to abandon the gold standard, causing gold prices to skyrocket. Here are some historical examples. First, Napoleonic Wars from 1803 to 1815. During the Napoleonic Wars, Britain suspended the gold standard in 1797 and instead adopted a paper currency system based on Bank of England notes. This suspension lasted until 1821 when the gold standard was restored. The enormous military costs forced the government to increase spending by issuing paper money instead of using gold to avoid depleting gold reserves. At this time, the price of gold in Britain rose nominally because the pound depreciated and inflation increased throughout the war period. In the 1810s, gold prices in Britain were 15–25% higher than their nominal value due to the depreciation of the currency. Second, American Civil War from 1861 to 1865. During the American Civil War, both the North and the South temporarily abandoned the gold standard. The governments of both sides printed paper money, called greenbacks in the North, to finance the war, leading to the devaluation of the paper currency and inflation. Before the war, the price of gold was fixed at about $20.67 per ounce. Soon after abandoning the gold standard, the price of gold increased significantly in the open market due to the depreciation of the paper currency. By July 1864, gold prices had risen to around $258 per ounce, an increase of more than 1,000% compared to pre-war levels. Third, World War I from 1914 to 1918. When World War I broke out, most European countries, including Britain, Germany, France, and Russia, abandoned the gold standard to print money for war financing. During this period, many nations had to prevent people from withdrawing or hoarding gold due to concerns about economic instability. A massive rush to buy gold could deplete national reserves. During this period, the U.S. public debt surged by about 2,450%, a massive increase. Corresponding with the rise in public debt, gold prices in the official U.S. market remained stable, but in the open market, they rose by about 20–25%. In Europe, gold prices surged more significantly, especially in Britain, where the increase ranged from 40–60%. Fourth, World War II from 1939 to 1945. In World War II, many countries continued not to follow the gold standard, although the Bretton Woods system was established after the war, in 1944, to manage international currency. The U.S. maintained its gold reserve system but reduced the ability of individuals to freely convert gold to maintain resources for the war. Global public debt rose by about 300–400% after the war. In the U.S., the data shows that public debt increased by 532% over a short 6-year period. Corresponding with the rise in public debt, the abandonment of the gold standard, inflation, and loss of confidence in the monetary system, gold prices soared. On the international market, gold prices increased by 25% during this period. Economic crisis leads to a sharp increase in public debt and a rise in gold prices after rescue efforts. Not only due to war, economic crises have become more frequent due to the growing debt bubble and rising inflation, which becomes increasingly difficult to control when currencies are no longer backed by gold. Economic crises often force governments to intervene strongly by increasing spending to stabilize the economy, rescue financial markets, or support the population. This typically leads to a sharp rise in public debt and a subsequent increase in gold prices. Below are some notable examples. First, the Great Depression from 1929–1939. The stock market crash in 1929 in the United States triggered a wave of global economic downturn. To handle the aftermath of the crisis, President Franklin D. Roosevelt implemented the New Deal policy, which included large spending programs such as infrastructure construction, agricultural subsidies, and social welfare. The government also increased borrowing to finance these programs, causing U.S. public debt to rise from 16% of GDP in 1929 to about 40% of GDP in 1939. While the New Deal helped reduce unemployment and revive the economy, it left behind a huge public debt burden. This was also the period when the U.S. abandoned the gold standard to print money to resolve the aftermath. The price of gold rose from $20.67 per ounce to $35 per ounce in 1929, a 69% increase, which was even greater than the rate of growth of U.S. public debt at the time. Second, the global financial crisis from 2007 to 2008. The collapse of the housing market and the credit crisis in the U.S. led to the bankruptcy of major banks. To address the crisis, the U.S. launched the $700 billion TARP, Troubled Asset Relief Program, to support banks and financial institutions. Many European countries, such as Greece and Spain, had to increase spending to bail out banks and stabilize their economies. The U.S. bailout essentially turned public debt into private debt. The Federal Reserve purchased $6.9 trillion worth of bad real estate debt, known as MBS, mortgage-backed securities, from U.S. financial institutions. All these rescue efforts explain why U.S. public debt increased from 62% of GDP in 2007 to 91% of GDP in 2010. Not only in the U.S., but in Greece, public debt soared, leading to the European debt crisis and forcing Greece to accept bailout packages from the EU and IMF. Immediately after economies completed the shift from private debt to public debt, gold prices surged, increasing by 39% from 2008 to 2014. Third, the COVID-19 pandemic crisis in 2020. The crisis stemmed from global economic disruptions caused by lockdown measures and a decline in business activities. Countries rolled out massive economic stimulus packages to support businesses, workers, and the healthcare system. The U.S. passed large support packages totaling $2.2 trillion, while the EU deployed a $750 billion support package. The outcome of the COVID-19 crisis response resulted in a new record for the U.S. public debt, which rose from 106% of GDP, 2019, to 125% of GDP in 2022. Japan's public debt surpassed 260% of GDP, the highest in the world. Many developing countries also faced rising public debt burdens, increasing the risk of defaults, such as Sri Lanka and Zambia. International gold prices have also increased by 42% since the pandemic began. This is a chart illustrating the positive correlation between U.S. public debt, as a percentage of GDP, represented by the blue line, and economic crises, represented by the gray bars, as well as gold prices, represented by the yellow line, from 1970 to 2024. The data shows that during economic crises and periods of rising budget deficits, the U.S. public debt tends to increase sharply. Since 2008, the U.S. budget deficit has surged unusually, The combination of record public debt and the ability to print money freely without being tied to the gold standard has encouraged governments to increase spending and print money beyond acceptable limits. This has led to a global depreciation of currencies, especially strong ones like the USD and EUR. This explains why gold prices have risen sharply and will likely continue to increase in the 6 months following Trump's entry into the White House. The weakening of the USD drives central banks to purchase gold reserves, along with rising U.S. public debt, which is closely linked to the strength of the U.S. dollar. The value of the dollar has been weakening. To mitigate this risk, central banks globally have been increasing their gold reserves as a substitute for the U.S. dollar. This has driven international gold prices to rise, as we are witnessing today. According to the World Gold Council, the net gold purchases of central banks reached 1,037 tons in 2023, with a record 1,136 tons in 2022. This is the highest level of net gold purchases recorded since 1950. According to a World Gold Council survey in July 2024, approximately 29% of central banks indicated that they would continue to increase their gold imports for reserves in 2024. Additionally, escalating geopolitical conflicts and the onset of interest rate cuts have caused gold prices to continue rising, setting new records. The continuous record-breaking gold prices suggest that investor confidence in financial markets and the value of the U.S. dollar have not yet recovered in 2024 and 2025. This will likely be one of the factors contributing to slower global economic recovery this year. Outlook for gold prices in the next 6 months. As analyzed, the increase in gold prices is not unusual, nor is it simply due to war-related panic. It has a clear and deeper origin tied to the ever-growing public debt, which continues to set new records, and the expected weakening of the dollar in the future. Public debt, in fact, tends to rise after wars and crises. Clearly, the expectation that wars will end, and the U.S. financial support for wars in Ukraine, Israel, and other pro-U.S. armed forces across the globe, will be cut once Trump enters the White House, contributed to a sharp drop in gold prices. However, President Trump will also need time to negotiate peace, at least 6 months, or perhaps even years. Additionally, post-war reconstruction efforts will continue to consume vast amounts of the budget, where the U.S. has a certain responsibility toward the international community. Domestically, President Trump will also face an expanding public debt, at least due to ongoing public spending projects. Not to mention, financial risks on Wall Street remain due to high interest rates, the Federal Reserve's slow pace in reducing interest rates, and the weakening of the USD. These factors erode the strength of the U.S. dollar and continue to diminish confidence in the U.S. monetary system. For these reasons, it is unlikely that gold prices will decrease. President Trump will need time to stabilize the enormous public debt, navigate the financial instability in the domestic market, and bring an end to wars outside the U.S. borders. Similarly, gold will need time to adjust,